Welcome to the Explainer. Today, we're doing a comprehensive breakdown of a quiet but honestly seismic shift in international tax policy coming straight from Revenue and Customs. This is the kind of structural update that usually happens totally behind closed doors, but it has absolutely massive implications for both multinational corporations and national revenues. Let's just dive right in, shall we?
I want to start things off by posing a pretty provocative question to you. Should a country subsidize the foreign losses of multinational corporations? Seriously, just think about that for a second. Because that question, right there, frames the core tension of our entire explainer today. We're looking at this incredibly delicate, high-stakes balancing act between multinational tax strategies, staying globally competitive, and protecting the UK exchequer from essentially footing the bill for business ventures that happen entirely overseas.
Okay, let's dive into this. The document at the very center of this shift is an official Revenue and Customs policy paper, and it was published on May 21st, 2026. Now, this paper outlines some sweeping, mandatory changes to exactly how UK resident companies are taxed on their foreign business operations. I'll be honest, it's a remarkably dense read, but we're going to comprehensively extract the absolute core mechanics here. What's changing, why the government says it actually needs to change, and who is going to feel the impact the fastest. So here's our comprehensive roadmap for today. First, operating abroad, the basics. Second, the current tax election. Third, the costly corporate loophole. Fourth, the mandatory exemption solution. And finally, number 5, timelines and anti-avoidance.
All right, let's kick things off with Section 1, Operating Abroad, the Basics.
When a UK company expands abroad, they generally face a big choice. They can either create a legally separate subsidiary in that new country, or they can operate through what's called a foreign permanent establishment, often just called a foreign PE. If you look right here, you can think of a foreign PE simply as a direct physical branch of the UK main company that's located overseas. It is not legally separate from the parent company. And this structural distinction between a separate subsidiary and a connected PE is the absolute linchpin of this entire policy paper.
Moving right along to Section 2, the current tax election.
And this brilliantly illustrates the crossroads that companies currently face. Under the existing UK law, a company is technically subject to UK corporation tax on the profits of its foreign PEs, but they can make an active election to change that. Side A shows exactly what happens if they do make that election. Well, it's irrevocable. The future profits of their foreign branches become totally exempt from UK tax. But crucially, any future losses from those branches, they cannot be used to offset their UK profits. Now look over at side B. If they choose not to make the election, the foreign losses of a UK company remain fully available to relieve the UK tax burden on profits made by the main company or even the wider corporate group.
Which brings us to Section 3, the costly corporate loophole.
So the crucial point is how these rules can be, sequenced to a company's immense advantage. According to the HMRC paper, a very specific pattern has emerged. Let's walk through it. Step 1. A company operates a foreign PE at a loss. Let's say they're in a heavy exploration or a messy startup phase. They use those foreign losses to offset and shrink their UK tax bill. Pretty handy, right? Then, Step 2. The exact moment that foreign branch finally turns the corner and becomes profitable, the multinational group subsidiarizes it. They literally turn it from a branch into a completely separate subsidiary company. And then Step 3. Because it's now a subsidiary, all those newly generated foreign profits are removed from the UK corporation tax charge entirely. And get this, doing this generally doesn't even trigger a taxable gain on the transfer. It's essentially an invisible tax maneuver. They are effectively privatizing the wins offshore while socializing all the losses against the UK tax base.
The government's policy paper very clearly outlines the severe financial imbalance this creates. The net result? The UK exchequer is essentially compensating multinational groups for costs and losses that were incurred entirely overseas simply by collecting reduced corporation tax on their domestic UK profits. And because of that sneaky maneuver we just looked at, the equivalent foreign profits are never brought into the UK tax net to balance the scales. Zero. Zilch. Furthermore, HMRC notes that sometimes UK profits are already heavily sheltered by other things, like double taxation relief. So ultimately, even in super unusual market conditions where a company is making highly elevated UK profits, their actual tax liability can remain substantially, almost shockingly, reduced because of this loophole.
Now you might be wondering who is actually taking advantage of this the most. Well, the paper states, and I quote, "This effect is particularly significant for groups which generate very large foreign losses or are able to claim very large amounts of capital allowances, for example, in the oil and gas sector." Think about it.
Heavy industry requires absolutely massive upfront investment, and that generates enormous capital allowances overseas. When those allowances are routed back to offset UK profits, the financial loss to the exchequer is amplified significantly.
Let's move on to Section 4, the mandatory exemption solution.
Now, what's really interesting about this slide is the sheer simplicity of the government solution. They aren't creating some complex, tangled new web of tests. They're just making the foreign PE exemption mandatory. That's it. You don't get to choose anymore. By mandating this exemption, losses attributable to a foreign PE can literally never shelter UK profits again. The paper notes this aligns beautifully with standard international practice to stop tax base erosion. They're also taking this opportunity to clean up the rulebook a bit, repealing some older, super complex legislation about taxing exempted PEs that have a total opening negative amount. But listen, here is the absolute most vital takeaway. HMRC is doing all of this while actively trying to preserve a simple, competitive exemption regime. They don't want companies to be discouraged from expanding abroad. They are decisively closing the loophole, but they are keeping the door wide open for global business.
And finally, Section 5, timelines and anti-avoidance.
Let's see how this all builds across the calendar, because the implementation timeline here is actually fascinating. So, the policy was officially announced on May 21, 2026. For most companies out there, this new mandatory exemption won't actually kick in until accounting periods beginning on or after January 1, 2027. Gives them a little breathing room. However, remember the oil and gas sector we highlighted earlier? Yeah, the government is dramatically accelerating the timeline specifically for them. For UK resident companies in oil and gas extraction and exploration, the government is forcefully deeming their accounting periods to end on August 31, 2026. And the very next day, September 1, 2026, bam, the new rules commence for them. This means any foreign PE losses arising after September 1st for oil and gas can no longer offset UK profits. It is a very swift timeline.
But HMRC isn't just setting a deadline and walking away. They are actively guarding the gates leading up to it. Transitional rules are being heavily amended. Basically, if a company has old losses from before the exemption takes effect, they cannot use those old attributes to relieve UK profits that arise after the effective date. Furthermore, really strict anti-avoidance rules are being introduced right alongside the draft legislation over the summer. This is specifically meticulously designed to stop companies from engaging in arrangements to artificially accelerate the use of their losses. Basically, they're stopping companies from rushing to squeeze the last few drops out of the loophole before the new rules slam shut for good.
And that really brings us right back to the delicate balance at the heart of international finance. Closing a loophole like this requires incredibly precise mechanics, tightly targeted timelines, and some very robust anti-avoidance guardrails. But it leaves us with this final, overarching thought. How effectively can a nation protect its tax revenues while still maintaining a competitive, pro-expansion regime for multinational corporations? Honestly, it's a tightrope walk that governments have to navigate every single day. I really hope this comprehensive breakdown helped clarify exactly how the UK is choosing to walk that line right now. Thanks so much for joining the Explainer today, and as always, keep asking the big questions.